Today, the markets are in a very interesting shape. Indeed, after a very positive first quarter for equity markets, the direction of the equity markets in the asset markets is less clear for the remainder of 2023. On the one hand, inflation continues remaining high. We see headline inflation actually decreasing due to the base effect of energy prices, but core inflation continues to rise and therefore continues to be high. This in turn will prompt central banks to have to continue hiking their rates for the remainder of the year. On the other hand though, we start seeing a recessionary risk appear in the market. We see economic growth slowing down, we see leading indicators pointing towards a recession in the latter part of 2023, and we see the current level of rates starting to be inhibiting for economic output. And this, we believe, poses a risk for the direction of equity markets for the remainder of 2023. We continue seeing opportunities in almost every asset market. In the equity market, for example, we believe that well-capitalized and defensive sectors are continue to perform well for the remainder of 2023. We think that the level of rates today is attractive enough for government bonds to be interesting investments. In the commodities space, we think that gold, with its defensive characteristic, is an interesting investment. Also, we believe that there is value in volatility in the equity market and volatility in the rates market. Today, we see risk lie in three different things. First of all, a policy mistake by a central bank that would either hike their rate too quickly or not quick enough, that would derail the economy or derail the confidence of investors into the central banks. The second risk that we see is a risk of confidence crisis in the banking sector. We have seen Credit Suisse being rescued by UBS in Switzerland. We have seen Silicon Valley Bank and Signature Bank in the US being rescued as well. If there is prolonged trouble in the banking sector, either in the US or in Europe, we believe that this will pose a risk to the equity markets, the bond markets, and the economy itself. The third risk that we see is a persistent high inflation that will force the central banks to hike their rate, raise their rate for longer periods, which will have a negative impact over the medium term into the economy. So in today's market condition, we recommend to be either defensive or take advantage of the volatility of the markets. In the equity space, for example, we recommend the space industry, which is defensive in nature because it's heavily subsidized by the public sector, or the healthcare industry, which has two main drivers that play for it. First of all, the change of demographics in Western countries and the rise of the middle class in the emerging markets that will sustain the need for healthcare in the future. In order to take advantage of the current volatility in the markets, we recommend either yield-enhancing structures on equity investments or structure like twin wins on select underlyings such as oil. Please be in touch with your contact at Lynceus if you would like to know more about the structure that we offer.